Howdy, y'all. Welcome back. It's the weekly economic update for September 13th, 2021. I trust everybody had a fantastic weekend. It was pretty nice here in the Front Range of Colorado. Did a whole lot of nothing. Watched a lot of football and plenty of Astros baseball. They won 2 out of 3 from the Angels, which is always nice. And I understand the Texans won on Sunday. Not watching pro football right now simply because they're idiots. But I am doing a fantasy football league, so I'm a complicated guy. But we'll see how that goes. All right, well, let's go ahead and jump into things. All right, we start now with the weekly economic update. The week on Wall Street in a quiet week of news. Stocks moved lower amid simmering concerns over the Delta variant's effect on the progress of economic reopening. The Dow Jones declined 2.15, the S&P dropped 1.69, the NASDAQ was down 1.61, and the MSCI was down 0.63. Stocks weakened. In a holiday-shortened week of trading, markets were choppy as investors grew cautious in the face of potential Fed tapering. In the face of a Fed tapering decision later this month and the impact of the Delta on the economic recovery. What little news there was, it was decidedly mixed. Job growth showed real strength coming off a shaky employment report the previous Friday, while the producer price index surged 8.3% year over year. That's not good. Representing the largest annual increase since November 2010. The release reminded investors that inflation remained at market risk. Stocks tried to stage a rebound on Friday before sagging to close out the week. Jobs improvement after disappointing employment report. 2 labor market reports last week appeared to show that the labor market recovery appeared intact. The JOLTS report, Job Openings and Labor Turnover Survey, showed that 10.9 million open jobs, a number that exceeded the number of unemployed by more than 2 million. So it seems like everyone who doesn't have a job could probably find a job if they actually put some effort into it. That's just me. That's just my, I'm just spitballing here. The rate of hiring, however, decelerated, perhaps explaining why August employment report fell short of expectations. It wasn't just short. It was grossly short. A day later, the weekly initial jobless claims report fell to a pandemic low of 310,000, coming in below its 4-week moving average of 339,500. Continuing claims fell to their lowest level since March 14, 2020. We probably covered that on Friday. All right, week ahead. Tomorrow we have the CPI. Wednesday we have industrial production. Thursday, jobless claims and retail sales. Friday, consumer sentiment. Earnings this week. Just today we have Lennar, and that appears to be it. All right. Also distributing the the retirement insight for this month. There's some interesting tidbits in here. First, it starts out possible changes for catch-up provisions for retirement accounts. Starts out since 2002, Americans age 50 and older have been permitted to make annual catch-up contributions to popular retirement products. But according to Vanguard's 2021 How America Saves report, just 15% of retirement savers do. One factor may be the limits on these contributions. Many pre-retirees who are old enough to catch up would like to contribute considerably more to their retirement plans as they need to ramp up their rate of saving. Proposed legislation making its way through Congress could allow people over 60 to make larger yearly catch-up contributions to some of the most popular types of workplace retirement plans. Essentially, there are variations of the same bill circulating in Washington. The Senate version would let those 60 and older make annual catch-up to $10,000 to employer-sponsored retirement plans. The House version also has a $10,000 annual maximum, but the enlarged catch-ups would have to be after-tax contributions. An after-tax contribution does not reduce your current taxable income by an equivalent amount, but may help you reduce your income tax burden during retirement. With many seniors needing to save more and much more before they continue their careers or sell their businesses, any new laws allowing larger catch-up contributions could be a benefit. I see the Senate side being a much better version. The House version only allowing after-tax contributions. I really don't see the benefit of that. Yes, investing after tax or in a Roth does give you either you pay capital gains or tax-free withdrawals. But, I mean, just in my own experience, it creates a big problem when you're contributing, after-tax dollars into a pre-tax account. It makes the record keeping a lot harder. So I would probably if the House version does become law, I would probably dissuade people from using that option, because it really doesn't provide a taxable benefit to you. But we'll see how it comes out. But it is good news that the idiots in Congress are doing something to actually help people. All right. The next subject is how about a gap year before retirement? For generations, teens in Europe have adopted a year off to adventure and see the world before starting their university educations, an interim commonly referred to as a gap year. It turns out that some American seniors are also taking a gap year between full-time work and retirement. But instead of avoiding campus, they're using the transition to take advantage of expanded adult education at our own colleges. There are some trends encouraging this, and one will not surprise you. The COVID-19 pandemic, according to a 2021 Age Wave study, has led an estimated 68 million U.S. seniors to adjust their exit dates from their careers, professions, and businesses. At the same time, universities are noticing that our country is growing older. By 2034, Americans age 65 and older will outnumber children. Adult learning, sometimes offered at nominal cost, is aiding pre-retirees and new retirees with ambitions to work in a new way, start a business, or embark on an encore career. A gap year may be useful life step to help them decide what to do next. All right. And one last little bit here on the bright side. The S&P took just 354 trading days to double in value from its March 23, 2020 close. This represents the quickest doubling of the market bottom in index's history. But as we do know, there has been a ton of cash created by the Fed. So whether or not you consider this a true doubling or just an inflationary problem, it remains to be seen. Okay, first white paper going out is the September effect. You may have heard this term bandied about on some of the business channels. Let's start out here. The stock market notched its seventh straight month of gains in August, and the Standard & Poor's 500 set 53 new highs so far in 2021. During August, stocks rallied as investors looked past the increased number of COVID-19 Delta variant cases and barely reacted when the Federal Reserve said it might begin tapering its monthly bond purchases by the end of the year. But it's a new month. You should expect to see an article or two about what's called the September effect. September is when many professional investors end their fiscal year, which can lead to some overall market weakness. When I see articles about the September effect, I'm reminded of my favorite stock market quote by Mark Twain. October, this is one of the particular dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. There's always going to be some market theory opinion or model that suggests that we're in this cycle or that trend. Over the years, we found the best strategy is to ignore the noise and focus on your investment goals. And also, pay attention to where the overall trends are going long term. Making sense. Next white paper is making sense of a seemingly inconsistent numbers. It can be incredibly difficult to make sense of data. A report coming off one body may tell you one thing, and another report might seem to offer a wholly different perspective. Such is the case with August jobs numbers from the Department of Labor. There was a vast difference between the number of projected in surveys of economists, 720,000, and the number we received, 235,000, increase in non-farm payrolls. Adding to the confusion, the unemployment numbers dropped in the same period from 5.4 to 5.2. You might be better versed in these numbers than the average person. For example, you might understand that these numbers are calculated differently and with totally disparate factors considered. That accounts for how unemployment can decrease, yet job numbers come in so low. To make matters more confusing, the Department of Labor and other groups measure employment in other ways. For example, ADP puts out a monthly report, while the Department of Labor also releases a weekly report on unemployment insurance claims. Wise investors take the longer view, understanding that while these numbers do affect and reflect the market, they don't always represent the full picture. By investing in a strategy that takes years to play out, you know that the economic big picture isn't a snapshot. It's an epic film. You always have someone who thinks in terms of the big picture in your corner. I'm happy to talk you through any questions you might have. So my ghostwriter put a nice little call to action in there. All right. And the last white paper is the best, the brightest, and inflation. If you're feeling a bit confused about the direction of inflation, you're in good company. Some of the best and brightest economists in the country are having a tough time getting their arms around current inflation trends. The most recent producer price index reading came in above economists' estimates at a record level of 8.3 compared with a year earlier. Producer prices can be an indicator of future price changes at the consumer level. One way to gauge inflation is to watch the people responding for managing inflation. The Federal Reserve Board of Governors. In recent weeks, the several governors have indicated that they are comfortable with how the economy is recovering, so comfortable that they appear ready to slightly change course with monetary policy in the next few weeks. Does that mean inflation will be lower in 6 months? I don't know. Time will tell. But keeping an eye on the Fed's actions may be one of the best ways to see what's next for prices. Remember, inflation is just one factor to consider when making adjustments to a portfolio. But if you're getting uncomfortable, please reach out. Hey, another call to action. Good of them. All right. I had two pieces I wanted to share quickly with you from First Trust Portfolios. First is from their weekly market commentary. Starts out, we've talked a lot about the equity markets already and the job markets. Do want to spend a little time talking about fixed income. Treasury yields were little changed last week in a relatively quiet week of economic data. The jobs opening and labor turnover survey released Wednesday by the Labor Department showed U.S. job openings reached a record 10.9 million in July. Initial jobless claims for the week on September 4th reached a pandemic low of 310,000. The 4-week moving average was 339,500, which was also a pandemic low, which we just talked about. Indicating that there's not been a rise in layoffs due to the Delta variant. The PPI increase of 0.07 from July to August and an 8.3 from last year. Both increases were above forecasts. August and year-over-year increases in the producer price index. Producer prices is the largest on record. So let me get down here. Major economic reports related to the young for an upcoming. Yeah, this is just all preliminary or data from the jobs report. So, all right. And down here, we had some interesting news. Let's see here. Moderna Inc., the biotech company best known for its COVID-19 vaccine, was the top performing stock in the S&P 500 index, returning 7.84. The stock jumped Thursday as company held an R&D day and announced that they were in the process of developing a combination vaccine for COVID-19 and the seasonal flu, and are developing a vaccine for RSV. Home builder PulteGroup showed the worst performance last week, declining 10.23. The company decreased their guidance for the third quarter and fiscal year 2021 due to impact from supply chains. So, I mean, this is something we've talked about a lot. I mean, with supply chain disruptions over the last year, I mean, we've seen where, food wasn't on the shelves or, the cost of goods, like with the computer chips coming out of Asia, that's been a backlog and has caused a lot of problems in the auto industry. The supply chains have really been disrupted, and, looking at the gross output numbers, it did rebound quite well. I'll be curious to see what the new numbers, when they do come out, what they reflect for, I guess it'd be second quarter or first quarter. All right. The company, okay. Apple Inc. declined 3.45% last week after a judge ordered that the company must give app developers an option of sidestepping their commissions from in-app purchases, which could lead to lost revenue of a few $1 billion. That's bad. Earnings announcements expected this week. We just talked about that. So, all right. And then the last piece of material I wanted to cover is from Brian Westberry, the chief economist at First Trust. He has good stuff every week. So just going to read through some portions of this, and then we'll wrap things up. If you've read our two most recent Monday morning outlooks, you know that we've raised forecasts for the S&P 500, but lowered our forecast for real GDP growth. How can that be? First thing to realize is that when we say we're bullish on stocks, that doesn't mean that we think the stock market is going to go up every day, every week, or even every month. It won't. Nor does it exclude the possibility of a correction in equities, which based on historical frequency is past due. talked about that a lot. I mean, yes, last year, we did drop significantly and rebounded. I know some people call that a correction or a recession. It was so short-lived, and it was, there was so much of a bailout from the government. We're going to have to wait and see when we go through an actual correction without any government influence and see how, see what really happens there. Let's see. We take a fundamental approach, valuing time in the market over trying to time the market. Corrections will happen from time to time, and we don't know anyone who can accurately forecast them based on a consistent basis. That is true. Without digging deeply into our capitalized profit models, which estimates a fair value for stocks as a whole, which remain bullish for three main reasons. First, long-term interest rates are low and likely to remain relatively low for at least the next year. Second, corporate profits are very high and will remain relatively high even if they pull back from record highs as the amount of government stimulus wanes. Third, even if real GDP growth falls short of consensus expectations in the next few years, nominal GDP, which includes both real GDP and inflation, should remain robust due to the Federal Reserve's overly loose monetary policy, see point above, which will remain extremely loose even as the Fed starts tapering later this year and ends quantitative easing around mid-2022. The key problem for real GDP is the massive and unsustainable fiscal stimulus and income support that happened during COVID pushed retail sales well above the pre-COVID trend. Retail sales in July were 17.5 above the level in February of 2020. To put that in perspective, in the 17 months before COVID, retail sales were up 5.1%. There is only one way retail sales can grow 3x its nominal rate while millions are unemployed and the economy was locked down. The government pulled out the credit card, and we've talked about that over and over again. So let me just drop down here to the last paragraph. The bottom line is that we are bullish for now, but fully recognize that we have been in a pristine environment for stocks. A slowdown in GDP will likely slow profit growth, while rising inflation will eventually lift long-term rates. Tax hikes are still a threat, and our tougher COVID-related restrictions that limit the service sector recovery. However, with the Fed as easy as it is, the tailwinds for easy money remain strong. The market is not overvalued, but it is not undervalued as it once was. All right, so let's close that. And I hope everyone, like I said, hope this was valuable for everyone. And if you need anything from me or have any questions, feel free to reach out. Give me a call, 281-724-8181, or shoot me an email. And have a fantastic week. Go out, get some sun, get some exercise, eat some healthy meals. That's how I stay so fit and trim. And get your workouts in. I got my workout in before put some clean clothes on for this. And have a great week. I'll talk to everyone on Friday. Bye-bye.